Well, Jeetu Panjabi joins us. Let's take the conversation forward with him. Jeetu, good to have you back and thank you for joining us. Jeetu, while world is not out of the woods, the economy is not back on the track, but there seems to be a divergence. Auto companies are telling us things are back on track. HDFC Bank is sharing with us that things are firing full cylinders. When you speak to a consumer durable vendor like Vijay Sales, they are saying that 80% of the recovery is back. My research colleague Ajay Sharma just forwarded me a picture of a sari shop in South where there are massive queues as people have started shopping again. So why are we looking at a disconnected world where data and the ground reality is very different?
Well, I think it is pretty clear that the health aspect of what's happening in the country is clearly creating these trends. And the fact is that, let me back up, any early cycle that you see in the world going back in terms of long 7 to 9 year cycles, you see a lot of asynchronous data points at that point. So it's not unusual to see what we're seeing. We're seeing some patterns where things are really moving hard. So there's a personal need and you're seeing automobiles moving up pretty well. And there are certain points where you don't have certain needs. And that's an asynchronous factor that you're seeing at work. So I'm not surprised by what you're seeing. But the point I'd kind of make is if we fast forward 6 or 12 months out, I see the economy gaining a lot of momentum. And a lot of that momentum will come from external factors like I would say the US and the Europe recovery will be much stronger. That's going to transmit into India, and that's going to see a few other cylinders firing away. And that together is going to get the economy to get much more momentum. So I think we're very, very early in the cycle. We're seeing a few cylinders firing. We'll see a few more firing along the way. And 18 or 24 months from now, my view is that we have a super cycle globally coming up.
Okay, for a super cycle to globally come up, a profit pool has to get created. Where do you think that profit pool is going to come from? In India, if I look at the top 3 corporates, Reliance is looking at deleveraging. Tatas have said that they would be using their cash flows to retire debt in companies like Tata Motors. And frankly, the sound bites from, let's say, a commodity-dominated group like Aditya Birla are also saying that they do not want to leverage. So for any economy to pick up, somebody has to take risk and some profit pool has to get created. Where will that get created in India?
So if you kind of go back, okay, let's kind of back up saying what are the drivers of the cycle and thus what the profit pool comes up. So the drivers of the cycle are extremely narrow at this point, and we can see that. In my view, as demand, aggregate demand picks up, incomes move up, employment, which is a lagging indicator, comes back into the cycle. Credit growth, which is a lagging indicator in the cycle, starts coming back. You see a significant broadening in the cycle. As you see a significant broadening in the cycle, you see aggregate demand go much broader and stronger. As you see that happen, profit pools come back. So there are pockets of the economy where you've seen cost cuts happen, but you haven't seen the aggregate demand move up significantly. And thus operating leverage is not fully playing out. So as you see operating leverage play out, as you see capacity utilizations get better, profit pools are there. I would say the number of businesses, the number of companies per business has shrunk. So what you were to say was a very competitive environment gets less competitive, which is great for profit pools. So I would say I'd be extremely bullish on profit pools a year or 18 months from now. But the question is, does the market price that today or does it take a little longer to price that in?
Sure. Jeetu, among the EM basket, really, where does India stand when it comes to attractiveness, fund flows? Given that, we were all anticipating, some benefit post the US-China standoff, not sure if all of that has been factored in as yet.
In my view, India stands pretty good. I wrote up a note just last week, which talks of belting up for the coming global super cycle and the world getting to $100 trillion world. I think the core drivers of that is that we see the deflator coupled with a weak US dollar driving capital flows and businesses and demand, external demand into emerging markets. That bodes extremely well for Asia in general, right? So I would not be surprised if in 3 or 6 months from now, we see a lot of US and European companies raise their schedules purchase schedules from companies in Asia and India included. As that plays out, we see demand widen. As that plays out, we see more credit growth and better capacity utilizations, and businesses do well. Now, to your pointed question on India and emerging markets per se, my view is that there's one new phenomena that comes out of this COVID environment, which is geo-neutrality, which basically means that you don't need an H-1B to be doing a services business in the US in the same measure as you needed to earlier. So if you take that in perspective, you kind of say that someone who's working in Bombay need not work in Bombay, can work in Indore, and someone who's supposed to work in New Jersey need not be in New Jersey, can be in India. As that entire phenomena gains momentum, and obviously a lot of it is tech-enabled, and thanks very much for the broadband infrastructure that's been rolled out in the last few years, which is enabling that, you see the services boom as a version 2.0 globalization accelerating over the next few years. As that accelerates over the next few years, India does much better. Coupled with that, I mean, you hear very clear sound bites and very clear active actions on the base of a Foxconn, a Winstron, a Pegatron, working on building out capacity to build out supply chains in India. And part of it is government initiative. Part of it is just opportunity and the geopolitics of what has happened in the last 18 months. So as both of these trends play out, which is one, all the large manufacturing supply chain companies coming into India and setting up capacity, and two, the services boom playing out because of geo-neutrality, you kind of see a significant boom playing out in India. I'm actually very bullish on India as this plays out. I think capital flows will be concurrent to all of this. So capital follows opportunity. And as we see a greater opportunity here, you'll see that play out. You can see it in the data right now, right? Reserves in the last 12 months are up $100 billion. Part of it current account driven, but part of it capital flow driven as well.
What is the one biggest risk, according to you, to this thesis playing out? Where can India falter? Would it be on policy, reform, any particular area that you feel has been under-addressed? What would you like to see more of?
So in my view, the biggest thing is not breaking equilibrium globally. Okay, and let me explain that in a second. Whether it's geopolitics disturbing the equilibrium that we have, at least in this part of the world, or we have US politics coming and reversing tax policy by Trump, which creates disequilibrium. So my core point is I don't want anything that breaks the equilibrium that we have in the world, because businesses say, create an environment and we'll figure out how to work through it. And whether it's Indian businesses or European businesses or Chinese businesses, it's the same story. So we have a certain equilibrium today. We don't want a disequilibrium. What are the two causes of disequilibrium externally in the near term, in my view? One could be US elections and reversal of tax policy. If there's other stuff that's happening, that's not going to be a big deal. But I think the tax policy will be a critical part from a US election standpoint. The second source of disequilibrium would be anything that is a kind of a spark point from a war or a battle point of view that happens somewhere in the region. I would worry about that. But barring those two key issues, I would say the cycle is taken off, the cycle is working, and I don't see anything from an external standpoint that really hurts that equilibrium from an external standpoint. From a local standpoint, if the government stays out of the way, probably does a little bit of help from a fiscal standpoint, especially on sectors that are stuck up a little, like the infrastructure sector or maybe low-cost housing sector that needs a bit of kick and push, as well as pays out the fiscal dues that are due by the governments to the private sector. I think once you do a few of those things, I think you're off to the races. I don't see anything stopping it. And when you catalyze that with a weaker dollar and external demand picking up, I think we're in for it. I mean, I think it's going to be a great story a year from now or 2 years from now. We're going to be talking a lot of bullish things, in my view. I think you can't see it out, but in my view, that's going to be pretty much the case.
Jeetu, how much of a risk could the upcoming US election pose? I was just looking at some of the notes on the top tax rates by state under the Biden tax plan. And I mean, New York City stands at 62%, the state at 58%, California at 62.6%. This is not going to go down well with the markets and definitely shake the equilibrium, like you're saying.
So my view is look, there are sound bites and there are things you do, and often the two are disconnected. And in politics, it's very often disconnected. So I wouldn't be surprised if the sound bites are for a particular factor of people voting for you, but the reality is different. In my view, the one thing that is reasonably a given is the reversal on the stand of the Paris Accord that Trump has taken. I think that gets reversed on day one. I think the US-China policy takes a few months to see crystallization on which way it goes. I think the tax rate story is yet to play out. I mean, depending on who his economic advisors are, depending on what they hear back from business, I think the jury's out on that. I do worry about it, as you're saying, and it is a concern. But that is the disequilibrium that we worry about from US elections.
Back home though, Jeetu, as an investor, how is it that you're supposed to tactically navigate through your portfolio? Stick with the leaders, or is it time now to bet on the contra theme, the banks, the underperformers?
Yeah, so I'm in the camp that one, we have a true economic recovery that's going to be extremely visible over the next 12 to 18 months, right? The leaders, which are the pharma companies and the IT companies, I think it's a pretty crowded trade in my view, right? Now, what are the factors that are going to be concurrent to this recovery? You see credit growth picking up. I think that's a big deal. So the banks are a great place to be. And remember, the number of banks that have raised capital, if I'm not mistaken, something like 80,000 crores has been raised in the last 6 months. So you've got enough capital and ammo in the few banks that are going to be riding this next wave. And so I would say banks is one. The second is industrial. I mean, look at it. If you're saying US and European demand on the back of an economic boom in US or Europe comes into Asia and India especially, then you're saying there's a lot of supply chain in India that's going to ride on it. Do you want to be levered to that? Yes. Is there an expectation today of a boom happening there? Absolutely not. Are you seeing concerns saying, oh, we fired people and it's going to be a really tough environment? Absolutely. So my view is that you have to have one slightly longer horizon. So stretch out your horizon from 3 months to 9 months. 2, you make sure that the companies that you're investing in are going to be the ones benefiting from this boom and cycle playing out. And 3, stay invested. I mean, it's a question of expecting a 30 or 40 or 50% earnings growth over 18 months, in my view, which is completely not in market expectations. As you see that play out, the market's going to move, and you just need to kind of be a little ahead of the market.
Jeetu, but we've been waiting for this revival in industrial not for months or quarters, for years now. From 2014-15, we thought that deep cyclicals in industrials will make a comeback, but that is not happening. Sometimes GST, sometimes RERA, sometimes demonetization, sometimes COVID. Every year, the recovery cycle is getting delayed. And B, the relevance of some of these businesses are also getting delayed. I mean, if commercial real estate slows down, it will have impact on cement, steel, and allied industries. Today, if we are looking at adopting more digitization and less travel, that will have an impact on ultimately steel demand.
So great point, Nikunj, great point. Okay, first, let's break it up, saying we've been waiting for this for 2 or 3 years. In my view, the last point of the boom was of a strong demand scenario from an industrial standpoint was first and second quarter 2018 calendar. Okay. And after that, it's been downhill. We went through the ILFS crisis. We went through a lot of other stuff, and it never really played out. In my view, a lot of it was external driven as well. So US and Europe, there were concerns that were late cycle. Most of the companies there did not invest. They pulled back on demand, and that transmission played out in Asia. You had concurrent issues on the two-wheeler side where you had insurance issues, you had emission laws come in. You had the same thing in other parts of the auto sector. And all of that coupled with capital being withdrawn by the NBFC from the last mile came and contracted with the marginal demand. And that slowed the economy down significantly. And what was the point that, we were expecting this to happen and it didn't happen. But what normally happens, so in my view, the last cycle ended in March, the last 9 or 10 year cycle ended in March 2000, and the brand new cycle was born in April 2000. Now you had a giant cleansing in those few months, and you've come back to reset demand to zero and saying what plays out from here. In my view, the kickstart for this entire thing would be sectors of personal mobility. That is a need driven by health. in my view, the second big factor would be external demand playing out. So if you go back and see Class 8 trucks have not done well in the US and Europe for last 2 years because they miscalculated and demand collapsed in US and Europe. In my view, we're in the early phases of a big boom in Class 8 trucks in US and Europe. And as that boom plays out, you'll see a lot of the supply chain in India riding on it. As that plays out, there'll be bearing companies, casting companies, forging companies, and the whole supply chain will start booming. And once you kickstart and light a fire, believe me, the rest of the economy picks up. So my point is, you had great reasons why that didn't happen for the last 2.5 years. There are very good reasons why that happens today. And remember, you're normally looking through a rearview mirror and building expectations based on that. In my view, the rearview mirror is really bad. The forward looking through the windscreen looks great. And you got to find that break point in your analytics and say, we're at the start of a brand new cycle.
Okay. So how do you propose one should participate? Because investing is about positioning your capital to benefit from future returns. That's what investing is, right? How does one go about investing in this market when the near-term visibility still lies with tech and pharma? The long-term visibility of the mean reversion may come with cyclicals and industrials.
So look, it's going to be a bumpy ride. It's actually first a great question, right? It's going to be a bumpy ride. There's never a linear story, right? You could have US elections, you could have markets down 5, 10, 15%. You could have a lot of volatility in the real world and stuff. And then you come out and the power of the cycle takes you out of that pain. And you probably could have summer 2021 that's kind of coming back in greater way. And the story I'm saying could get pushed out by 3 or 6 months, right? If you're going to be heavily going into the industrial side, that's going to be a bumpy ride. So my core thesis is one, you got to focus on really good companies, the companies that benefit out of in any environment, or the survivors. And I think this is a K-shaped recovery in my view. In every industry, in every business, there are guys who are going to win and the guys who are going to lose. So you've got to make sure you're with the good guys and the guys who are going to win. Second, I don't think I'm going to rush all in and buy 100% financials and industrials. But if I look at market portfolios and I look at mutual fund portfolios, they're less than 10, 15%, at least the industrial side, less than 10% of most portfolios. Would I double that weight? Absolutely. Also, do I think that the financial side, which is not in the momentum trade right now, and people are really cautious, would I load up on that and say, okay, I'm increasing my cost of capital expectations or return on capital expectations of the next 18 months to 30 or 40%, and then, hold your nose and buy it and then run through the volatility? I think that's a fair way to do it. So I would still own good businesses which are bottom-up picked, but I'd definitely increase my weight on industrials and financials very significantly over the next few months. And I would use the volatility in the US elections, if any, as an opportunity to buy into this trade or put this trade on. It's only like 2 weeks away. Would I double that weight? Absolutely. Also, do I think that the financial side, which is not in the momentum trade right now, people are really cautious, would I load up on that and say, okay, I'm returning...
Sure, absolutely. Just wondering then, Jeetu, the point that Nikuj was earlier talking about, that all the chatter and channel checks seem to be indicating that consumption is slowly coming back. Within the consumption basket then, how is it that you're going to play the rural recovery along with urban recovery now, the entire theme? Would it be through home improvement companies? Would it be, through any other segments that you spot as good bets to buy into right now?
So in my view, I think it's a great question, right? In my view, the rural trade is a pretty crowded trade for good reason, right? Rural's really doing well. Everybody you ask, you kind of say, oh, the rural side is really rocking, and you see tractor sales. That's clear numbers out there. Do I think that the business cycle there looks like it's near-term peakish? Absolutely. Okay. Do I see signs of a pickup in urban in a very significant way? Absolutely. So I would say I'd shift from rural to urban from a consumption standpoint. I think that trade will be, or that turn in the real world will be very visible, and you have early signs of that playing out. Second, I think the easy trade, in my view, is take the auto side, right? The autos many of them have done well, but if I take the entire supply chain, the supply chain feels, like you look at some of the auto component guys, they've not done well at all, and people are extremely uncomfortable saying we don't know what's going to happen and are the profit pools going to come back, as Nikunj was saying earlier. So in my view, the whole automotive chain is a great place to be. I would say broadly that urban discretionary basket is a great place to be, because the urban discretionary basket starts playing out 12 to 24 months into the cycle. It doesn't play out day one of the cycle. The staples and the other non-discretionary items play out early in the cycle. So in my view, the discretionary basket, the urban basket, and autos on the chain are clear proxies for playing that.
Okay. Jeetu, great to have you on the show. Thank you so much for sharing with us your insights.
Thank you very much for having me on the show.